Welcome everybody to the Timberwalk investment presentation. My name's Ruben. I'll be walking you through a couple of things here, but really excited to introduce our partnership here between Legacy Acquisitions, Life Mission Capital, and Lone Star Capital, a group that we're very excited to work with because they have a great deal of experience in the Houston market with, I believe, over 2,500 units after the acquisition of this Timberwalk deal. So we'll chat about that as we go. Can you skip ahead to the disclaimer, please? So just wanted to mention really quickly that this is going to be a 506B offering that's only going to be available to people that have a ongoing relationship with somebody on the team, whether that's Missy Kashoff, Robert, or myself. And we will send a copy of this presentation out for everybody to review, including the disclaimer here. Next slide, please. All right, so Timberwalk is going to be a very exciting deal. Rob's going to be talking about that, the Houston market once again. And then I just want to introduce a little bit about our team at Legacy Acquisitions. But before I do that, let me kind of show you the breakdown so I can set the expectation for what we're going to be doing here today. It's going to be a really quick team intro and investment overview. And then we're going to be doing a sub-market, but the order is going to go like this. I'm going to introduce the team, and then we're going to turn it over to Rob. Rob's going to tell us a little bit about his track record and some information about why he knows the market better than most anybody that I know. And then we'll turn it over to Missy, and then we'll finish off with Kashoff. Next slide, please. All right, so just quick about our partnership here at Legacy Acquisitions. Very excited to work with Kashoff. I've been working with Andy McMullen for the last year. He has transacted over close to $750 million in real estate as a fund manager, as a broker, as a syndicator. And he and I have ventured into the build to rent space. We have 98 units that we're building in Louisiana, and then another 150, which are doing 506C style. And we're very excited to step into this space. But the other thing that we do in conjunction with Kashoff is we find the best operators in the country, and then we partner with them. So we're really excited to work with Rob in this capacity. Kashoff has been fantastic since he came on. He's got over 1,000 members at some of his different groups, both with Amazon and with Meta that's got 4,000. So we're really excited to do the build to rent space. But enough about us. Let me move on to Missy and Rob. These guys are fantastic. Really excited to be working with Missy. She's already syndicated 148 units and has her own investment club with over 600 people. I wanted to introduce Rob real quickly too, the author of the Definitive Guide to Underwriting Multifamily Acquisitions, which is available as a bestseller on Amazon, I believe. So I read that book. It's a quick read, but it's very intense. There's a lot of good information with that in there. So I recommend picking up a copy. But Rob, why don't you give us I'd rather have you tell us a little bit about you. I mean, we're obviously very excited to be partnering with you on this deal, but why don't you give us a quick synopsis of your background and, how you got into this space?
Sure, absolutely. I appreciate the intro. So, hey, everybody, my name is Rob Beardsley. I'm the founder of Lone Star Capital. About 4 years ago, my business partner, Kent Petrokovsky, and I, we founded Lone Star to focus on owning and operating workforce housing throughout Texas. Since inception, we've acquired about $300 million in assets, which is now about 2,500 units. Again, all focused in the Texas market with a particular emphasis on Houston. We've actually last year launched our in-house property management company, Radiance Living, which solely serves our Lone Star portfolio, in that we're now a vertically integrated owner operator with boots on the ground. We have a 3-person team in Houston to oversee all of our operations, and it's kind of a doubling down on the market that we really want to stay focused. Prior to forming Lone Star, I was working in my family's real estate business, coming from the single family world in California, as well as some small multifamily, before transitioning to Lone Star. Prior to Lone Star, for Kent, he worked as a tax attorney at MetLife for 10 years and advised on private equity transactions from a tax perspective. So to dive into a couple of case studies, just to give you a sense of our previous deals and the way we operate in the market. This is our first deal we acquired in Houston back in 2018, called Cranbrook Forest. It was a 261 unit off-market acquisition that was a very intense, deep value add. We bought the property at nearly 30% vacancy with a lot of crime and a lot of deferred maintenance. And we were able to both do interior and exterior CapEx, as well as really improve management a lot to be able to both bring up occupancy as well as raise rents 20%. And then we were able to successfully exit late last year for a 17% net IRR to investors. And that was about a 3.5-year hold in total. And that deal really showed our ability to manage a large construction project, really change the culture and the management at a property, which is definitely not easy to do and takes time. But we were able to successfully navigate that business plan. Moving on to case study number 2, which is another great example of really identifying an opportunity and then executing on it through our management, is Verandas at Bear Creek. And this is also a really strong case study as it relates to the deal we're talking about today, which is Timberwalk, because these deals are just right down the street from each other. So same street, same submarket, really same year built nearly, very comparable. And also the story and the business plan is very similar as well. When we acquired Verandas, it was about 80% occupied, so a little bit lighter on the occupancy side of things, but it was in overall pretty good condition. So really the value and the key to the deal was all in managing the property better than the current owner, rather than just trying to spend CapEx to bring up the value of the asset. So that's exactly what we did. We were successfully able to come in, both bring rents up to market by about a $100 increase over a couple of years, as well as bring occupancy all the way up to 100% as we marched through our initial lease up, and then maintain occupancy above 90% through stabilization, which is indicative of the strength and tightness of this submarket. This pocket where Timberwalk and Verandas at Bear Creek is a very high occupancy submarket. So when we start talking about Timberwalk next, you'll see that the occupancy at Timberwalk lags the market a little bit, and we have a lot of confidence in our ability to bring it up to market rates to maximize cash flow and of course value for investors. And this property, actually, Verandas, is under contract, and we anticipate returning over 30% for our investors in about a nearly 3-year hold period. So this page just gives you a sense of our total portfolio. As you can see, most of the properties that we have purchased and own today are in Houston. We know the market very well. As Ruben said, we underwrite about 500 deals a year in Houston. So we pretty much, we pride ourselves on seeing every deal there is to see. So we really have the best data and insights as to what makes a good deal in the market, and then also have the skills to actually go and execute on that opportunity.
Great. Well, thank you, Rob, for that wonderful introduction about your company. And I love the fact that you guys have your own property management company as well, which really helps make the operations a lot easier and implementing the business plan as well. What I'm going to talk about next is the investment overview. And a few things that we love about the deal is first, that Rob and his company is a really experienced operator in the Houston market. And the Bear Creek submarket has experienced 11% year-over-year rent growth as well. And this is an off-market purchase. The fact that it is off-market even received as much wide attention and helped us get a more competitive pricing for our investors. With Rob mentioning about the Bear Creek property that they're actually in the process of selling, where it has actually inferior interior but has $100 more in rent. So that just further proves that this opportunity we're presenting, Timber Creek, is a true value add opportunity. And the fact that we're anticipating getting a fixed rate loan with optional extensions is really providing us the ability to go against the variable interest that's out there in a lot of the deals. Lastly, the exit price that we have on this deal is very conservative. You'll learn a little bit later that our exit price and our exit cap rate is a lot higher, a lot more conservative, about 100 to 125 basis points higher than what's in the current market. So here are some additional details on the things I just mentioned, and you can read about in your own time. A few other key details is that In terms of unit mix, this is a 60-40 unit mix with 60% one bedroom and 42 to 3 bedroom, averaging 717 square feet, with an average monthly rent about $1,031. It's a 1983 built with 300 units. It's very close to a lot of major employment and highways, such as the Katy Highway and also the Texas 6 Highway. The median household sales in Bear Creek is about 231,000. Usually prices are being listed about 225,000 and 340,000. Not only we're seeing about 12 to 11% year-over-year growth in the stock market based on the last year, future rent growth projections are over 4% all the way through 2025 as well. We're purchasing this at $114,000 per unit, with a capital expenditure budget about $3.5 million. The target returns on this property is 16.7 IRR and 1.56 equity multiple. Those are for the Class A shares, which are $50,000 minimum investment. And for the Class B shares, it's $500,000 minimum investment. It is an average 18.7 average return for the Class A shares, and all the distributions are monthly based on available cash flows. No matter it's Class A or Class B, we prioritize investors' return first. That means first we'll distribute investors any accrued or unpaid 8% pref return for Class A, and that will be 9% for Class B. Then we distribute 100% of the investors' original invested capital back. And the third, we distribute up to 15% IRR based on a split of 70-30, 70 going to LP and 30 going to GP. Lastly, anything beyond the 15% is 50-50. That's very similar in the Class B, except for the pref at 9%, and also the split stays at 70-30 after the pref return. The 3-year projected pro forma, you can also see in a little bit more details here with Class A and Class B. In terms of fees, there's a 2% acquisition fee and 2% asset management fee. How we intend to do this? We'll work with Rob and his property management company as well. But the plan is really to do a value enhancement plan in 4 areas. One is on interior upgrades. Timberwalk currently has mediocre finish in their units, which you'll see in some of the pictures in a little bit later. Lone Star will renovate all the units to 2 different type of plans. One is a premium finish, which is 75% of them that we plan on doing, which will do backsplash, hardware, lighting, VP flooring, sheetrock, baseboards. So that will get us to about $103 rent increase, which is already demonstrated in the market with another property that Rob and his team is selling. And another 25% will renovate to more of elite finish. That would equate to about $203 rent increase. And we'll do all that while we continue to tighten the operations. And this will be done with a roughly $11,800 per unit capital expenditure budget. We'll also be installing washer and dryer. As you know, those are very desired features that the residents are seeking. We'll be installing washer, dryer, and adding connections in 60 of the units. In terms of amenity enhancements, we're really looking to add value to our residents with things like improving the fitness centers, poolside grills, signage, business centers. We'll also be adding reserve parking, 107 of them, with $30 per month, further improving our revenue as well. Lone Star and their property management company has been having a lot of best practices, as you can see from their experiences in the market. So they'll bring those best practices onto this property and further improving operation efficiencies as well. Through all of those, we're looking at creating a value of $18 million with a conservative cap rate of 5.25. So this is just another example, another view of looking at the projected returns. For example, for Class A, at $100,000 investment example, Year one projections would be 5% roughly, year two would be 7.5, and year three, 10%. And this growth is due to a combination of improving operations and continuing to improve our rent income as well. In terms of a $1 million improvement investment example for Class B, the cash-on-cash return is similar, but the pref, like mentioned earlier, the pref and the split are different, as you can see here in the investment example. And depreciation for year round is roughly about $40,000 for a $100,000 investment example. The financing on this, we're anticipating a fixed rate financing, 3.95 in terms of interest rate, and it's +1 with ability to extend to 2 more years. We'll either sell or refinance upon finishing the value add. In the past, Lone Star has been able to refinance typically within 18 months, but we had underwritten here to finish the whole plan within about 24 months. Keep in mind that refinance is not underwritten within the returns. What we're showing here is year 3 sell, exiting within 3 years. As I mentioned earlier, the exit rate is really conservative at 5.25, which is at least 100 to 125 basis points higher than the current market cap rate. In terms of the property, you can see quite a few pictures here. It's in fairly good condition, and it is a Class B asset as well. Here's some of the pictures of the interior. As you can see, Rob in the picture walking the units, doing the due diligence. What you see on the first 2 pictures are mostly representative to what the units look like, even though there are some older units that looks even worse. And then what you see below are some of the model units they have. It's interesting that today their model units actually doesn't look anything like what the tenants actually live in. So with the renovation that we have in place, we'll make the property look even nicer with some of the upgrades that we talked about. The 75% going to more of the premium finish and 25% going to more of the elite finish mentioned. In terms of the exterior, we see that the roof is actually in pretty good condition, can last for quite a few more years. And in terms of the electrical wiring outside, we did see some issues that we expect to finish the repair on once we took over the property. And that's already considered in the capital expenditure budget. But nothing else is too out of the ordinary that's should be concerning. In terms of the amenities, we have the 2 pools here and also the business center, the grills, and we'll be repurposing the sports center as well, along with adding the reserved parking mentioned for $30 a month on 102 spaces. This is in terms of the unit mix. We'll have 60-40 split like mentioned. Between the rent and pro forma, we're seeing about $100 to $150 increase. So the increase in rent isn't too aggressive compared to some of the other markets. And it's already been mostly tested with about $100 of those rents. So overall, we feel really good about this deal, and we're really excited to partner with Lone Star on this property. So I'm going to pass it on to Keshav to talk about the stock market and further investment analysis.
Yeah, thank you, Missy. Hey everyone, so we'll be going through a submarket analysis, just taking a look at Houston and Bear Creek, as well as doing a deep dive in some of the numbers for this opportunity. So this is the market overview. So Timberwalk is located in the Bear Creek submarket, and according to the RD Matrix, Bear Creek's seen an average around like 13% rent increase over the past year, with another projected 6% increase coming up this year, as well as just tapering down to the upper 4s in the next couple of years over our hold period. But in our underwriting, we're only projecting for 3% rent growth every year. So anything on top of that's just icing on the cake. And like Missy mentioned, Timberwalk's mostly centered around a suburban lifestyle for retail and construction and service type workforce housing. The homes there sell for between the mid mid 200s to the mid 300s. And as far as like other apartment complexes, we do have some new construction in the area that do rent for 400 to 700 bucks higher per month. And that's just a good place to be, just because workforce housing obviously can't compete with, you know, newer build apartments, Class A apartments. And it's also nice, you know, in case of an economic downturn, it's always nice to be closer towards the middle of the market, and it makes us feel really safe about where we are. This is a little more about the submarket. We already mentioned easy freeway access, as well as what kind of employers are in the area as well. And the Texas Education Agency also rates the schools in the area on either exemplary or recognized, 75 out of 78 of them. So that's, you know, great for the kind of tenant base that we'll be appealing to. And this is kind of what the neighborhood looks like around Timberwalk. So Timberwalk's those two white boxes there. And you'll see the retailers that we mentioned nearby, right? In IHOP and Dairy Queen, as well as the suburban, you know, developments, homes and apartment complexes as well. And here we're just zooming out a little more. We see more of that retail with big names like Walmart and Target. And then next, this is just some statistics on the submarket. So median household incomes between $60,000 to $75,000. Again, mostly in the retail, service, and construction industries. And that's, yeah. This is just to put Timberwalk into a kind of broader perspective with respect to where it is located in the Houston market. So we're about 30 minutes northwest of downtown Houston, easily accessible by hopping on any of the nearby freeways. And we're also pretty close to the energy corridor as well. We like this location just because, you know, our partner Lone Star Capital's focus is workforce housing. So we like to look around, you know, this 30 to 1 hour range drive around downtown areas. And now we'll be going into the investment analysis. So these are some rent comps nearby Timberwalk, just other apartments as well. And the main two points that I'll draw out here is one, our competition is nearby in Bear Creek's Crossing, and they actually have inferior interiors, but they're charging $100 more than we are already. So that's good to know that our prices are proven in the market. And secondly, Rob's exiting on another property right across the street, and verandas at the Bear Creek that he mentioned in an earlier case study. And so we're very familiar with this local neighborhood. Here we have the rent comps for those nearby apartments, just based on different unit mixes. So you can see what 1 bed, 1 baths, 2 bed, 1 baths, etc. are renting for, and where we come in that range. And these are sales comps for what other apartment complexes have sold for in the recent months in the nearby area. And what I'll draw your eye to is just the price per unit. So it ranges from $120,000 to $200,000. And the average is somewhere around $150,000, which is where we'll be exiting in 3 years. And that's where the market already is. So again, another good sign for us. And we're also coming in at $114,000 per unit. These are pro forma financials. So if you look all the way to the left, you'll see the trailing financials, which is where the property is currently. And our game plan with this is just our typical value add business plan to increase the income from 3.7 million, the gross potential rents, I should say, from 3.7 million to 4.5 million by the end of year 3, mostly through interior renovations. We'll also be cutting down on the loss to lease and vacancy loss as well. Putting that together, we're looking at a 9% increase in gross income year over year on year 1, 19% in year 2, and then 11% in year 3. And on the expenses side, we'll be reducing our payroll budget, just because our partner Lone Star Capital is very experienced in the Houston market. So we know how to run a tight ship there, and what needs to be done to operate a 300-unit apartment complex. And we'll be turning up the repairs and maintenance and turnover budget as well. Currently, they're very low, which kind of speaks to why the apartments are in the shape that they are, but we want to turn that around, so we'll be bumping those numbers up. This is our CapEx budget. So our CapEx is going to be a total of $3.5 million. And this is just a line by line breakdown of where all that money is being allocated. And this is our sensitivity analysis. So when we make our financial projections, like the 16.7% IRR, the internal rate of return, or the 1.56 equity multiple, we make certain financial assumptions about the market. Two of them here are annual rent growth and the exit cap rate. So our assumptions are that we'll be seeing 3% annual rent growth and a 5.25 exit cap rate. But obviously those are only our educated guesses. So, sometimes it helps to kind of pull the levers on some of these numbers and see what the returns will look like. So if just to read through these tables for a little, if you increase your annual rent growth going to the right and you go all the way up to 4%, then you'll see that our exit cap rate goes up to 18.6%. On the other hand, let's say our exit cap rate, instead of being 5.25, goes all the way up to 6, then our IRR drops from 16.7 to 8.7. So there's various different combinations of annual rent growth and exit cap rate and how they affect our financial metrics. To put cap rate into perspective, Rob's exiting his verandas at Bear Creek property around like a high 3 cap rate right now. So if we take that, then the market would have to expand 100 to 125 bips in 3 years. And to put that in perspective, during the last recession, we saw around a similar cap rate expansion of 120 bips. So, something would have to turn out really bad for us to miss our cap rate. And if that does happen, then our plan is to refinance and hold for the cash flow and sell when we feel that we can deliver on our investor returns. This is more sensitivity analysis. So in this page, we're looking at how bad debt, which we're assuming to be 1%, stabilized, and vacancy, which we're assuming 5% to be stabilized, will affect our cash flow. And this table operates very similarly to the one on the last page, so I won't spend too much time here, but it's just good to see how cash flow is going to be affected by these two factors, because cash flow is a very important part of any real estate investment. And so that's the presentation, and these are the next steps. So we're going live with the investment right now, and our funding deadline is April 29th, so not this Friday, but the next Friday, and we're targeting a closing date of May 17th. In the meantime, review the materials we'll be sending your way. Feel free to reach out to any of us GP partners regarding next steps or any questions you have. And we thank you for listening and look forward to partnering with you on this opportunity.
Yes, thank you again. And please reach out to the co-GP partner that invited you to the webinar. And we're very excited about this opportunity again. We really think, the few things we mentioned will really make this a strong deal, whether it's continuing to be an inflation market or a potential recession coming as well. So thank you again. Bye, everyone.